Jared Dillian. Now you know a rich guy.
I'm Jared Dillian. This is the Jared Dillian Show. This is a show about money and finance and the stock market and the bond market. And if you'd like to call in to talk about that stuff, you can call 844-305-7800. That's 844-305-7800. I encourage you to call in. You can also go to my website, which is jareddillianmoney.com. Or you can follow me at DailyDirtNet. And before we get started, breaking news, I just saw that President Trump wants to buy Greenland, like the island, like the biggest island in the world. He wants to buy Greenland. And it's not a terrible idea. First of all, it's more America, which is good. We can give it 2 Senate seats, although they would probably vote Democratic because right now Greenland is owned by Denmark. Who knows? So that's what's going on in politics right now. We're thinking about buying Greenland. What's happening today is the bond market is going absolutely bananas. And my guess is you don't focus on the bond market. My guess is if you focus on any market at all, you focus on the stock market. And if you have a television on with cable news or any other kind of news, it has maybe a ticker or it has the Dow Jones or the S&P 500 or the NASDAQ, and you basically, kind of see where the stock market is going on a day-to-day basis. But you don't pay any attention to the bond market. And the bond market is many times bigger than the stock market, and it's many times more important than the stock market, which I've said before. And what we've had in the bond market over the last 6 months has been nothing short of extraordinary. Absolutely extraordinary. A huge move in interest rates. Although, I'm going to tell you the move in interest rates that just happened. And 10-year interest rates went from 3.25%, and now they're at 1.5%. And that may not seem like a lot, but that is a massive historical move. So let's talk about interest rates and what they are. And interest rates are the cost of borrowing money. That's an oversimplification, but that's essentially what they are. And they measure the time value of money. For example, if I borrow $100 from you, you can charge me 3%, because if I didn't borrow it from you, you could have used that $100 to do something that would make 3%. That's the idea. There's a cost for borrowing money. It's called a time value. And if interest rates are low, that is good if you are a borrower. So obviously, if you want to take out a mortgage to buy a house, you like it if interest rates are very, very low. And I think mortgage rates right now are 3.5%, 3.75%, something like that. If interest rates are low, if you are a saver, that is very bad. And this is an environment that has been very bad for savers. And we'll talk about that. By the way, President Trump is obsessed with having interest rates lower. And the reason he's obsessed with having interest rates lower is because he's a real estate guy and he always borrows money. He's not really a saver. He doesn't care about savers. He borrows money all the time. So from his standpoint as a real estate guy, he wants interest rates low. But there's two sides, that's a double-edged sword. If interest rates are low, borrowers benefit, but savers do not. If interest rates are high, that's bad for borrowers, but it's very good if you're a saver. And I remember when I was 8, 9, 10 years old, and I was getting an allowance, and my mom, to teach me about money, got me a savings account at the local bank. And this is back when this was all done by hand. And it was called a passbook savings account. They don't have these anymore, but basically they would give you like a little notebook, and it would, you would deposit your money in the savings account, and it would just say how much you had. And it was just sort of a ledger, and you could just carry this little notebook around. It was a passbook savings account. Anyway, back then I clearly remember you walk into the bank and it had all the interest rates on a sign, and interest rates back then were about 8%, much higher than they are today. And they've actually, if you go back in history, if you go back in the early 80s or the late 70s, interest rates got as high as like 14%. So we've had very high interest rates in the past. If you think about what an environment would be like with 14% interest rates, it would be very, very hard to buy a house. But it would be awesome if you were a saver. It would be absolutely awesome. So right now, if you were buying a house, terrific. This is great. And in fact, we'll talk about this a little bit later, but if you have a mortgage that has an interest rate of 4.5% or higher, you might want to think about refinancing your mortgage, but we'll talk about that later. So it's great if you want to buy a house, but if you want to save for retirement, it is extraordinarily bad. And if you think about how this has progressed over time, back in the mid 80s when I was talking about when I was 8, 9, 10, 11 years old, saving down at the bank, in the old days, you could actually save for retirement in a bank account. I mean, that's ludicrous nowadays that you can do that. But back in the mid 80s, you could just keep money in the bank and earn 8% and save for your retirement. And then what happened was interest rates started to go down a little bit. And people, in order to get a little higher yield, they had to lock up their money in a CD. So, a CD is what's called a time deposit. It's called a certificate of deposit. And if you don't know, basically how a CD works is you go to the bank and you say, you can take my money for a year and I can't touch it. I have to leave it there. And I get a slightly higher interest rate. And you can get your money back out of a CD, but they charge you a penalty, so you should try and leave it in there. And then what happened was CDs didn't yield enough, so people started going into treasury bonds. And treasury bonds, the government's not going to default. You're going to get your money, but there's interest rate risk, so those are a little more risky. And then people couldn't get enough interest in treasury bonds, so they had to go to corporate bonds, high grade, high quality corporate bonds. But then those were yielding like 2, 3, 4%. So people got pushed out into high yield bonds, which are junk bonds. And by the way, now we're getting into recent history. So in 2010, 2011, it was very common to put retirees into junk bonds, which back in the 80s would have been considered unfathomable, that you had 70-year-old ladies going into junk bonds. And now the junk bonds yield about 3 or 4%, and now people are going into stocks. So what has happened over time is that interest rates have gone lower and lower and lower and lower, and savers can't save money. They can't save money at all. So it's forced them to take more and more and more risk. It's forced them to take more and more risk, which is bad. I've told stories before about how my 73-year-old mom, was advised by her financial advisor to go into aggressive growth stocks. And this is where we are. This is where we are. People are taking exorbitant amounts of risk because they can't get a safe return anywhere else. We're just crushing savers. So let's briefly talk about what's going on here. Actually, let's take a call. Sarah from Vermont. Sarah, you're on the air. How can I help you?
Hi, thanks for taking my call. I have a personal finance question about college. So I'm 54 years old. I have a son in high school. He's going to go into his junior year, and he wants to go to a good college. He's super smart. And the problem is, as always, I make too much money for financial aid, but I make too little money to finance his college. I don't have a lot in savings. I only have like 10 years to retirement age, basically. And so what am I going to do?
Do you have anything saved up already in a 529 or an ESA or anything like that?
It's marginal, really.
What kind of schools is he looking at?
Well, he would love to go to Harvard and stuff. The thing is that Harvard charges you $15,000 a semester if you make less than $80,000. If you make over $80,000, charges you $45,000 per semester. So I'm like right on the edge there, and it's.
Okay, so we're gonna, we got to run. Stay on the line. We will talk about this when we get back. I'm Jared Dillian. This is the Jared Dillian Show.
The Jared Dillian Show.
Hi, this is Jared Dillian. Catch the Jared Dillian Show from 6 to 8 Eastern only on the Smart Talk Radio Network.